I'm Doris, and I'm here to share with you about the bear market and the future of raising interest rates policies. After the Fed decision, U.S. stocks appear to have temporarily lost momentum for further gains. The hot job market has led many officials to say the fight against inflation is far from over, pushing the market interest rates higher. The earnings season showed that overall sector earnings began to be affected by the economy. Concerns about a recession returned as the rate hike cycle continued. Investors are waiting for January inflation data to weigh potential options for the policy path, with a bear rally in the eyes of many analysts. Fed officials spoke hard in line. Over the past week, several Fed officials, including Fed Chairman Colin Powell, have commented on the outlook for the economy and monetary policy. Fed stood its past its inflation target was reinforced after the unusually strong January non-farm data. Powell believes that while the anti-inflation trend is emerging, continued strong job growth led to higher wages and prices will further tighten monetary policy, and interest rate could exceed money market pricing levels. Officials, including the New York Fed President William Williams and Fed Governor James Waller, said restrictive policy rates remain important and are expected to last longer to meet the target. Arnold Schwartz, a senior economist at Oxford Economics, told China Business News that the Fed is consistent and firm in its determination to reduce inflation. For now, the Fed will not ease its tightening policy this year, and if inflation exceeds expectations before the March meeting, its end interest rates target would be revised to up further from 5.1% in December. Fed funds futures pricing continues to adjust. The market now expects the Fed rates to peak at 5.13% in June, while implied cut narrowed to 18 basis points, less than room for a single rate cut. JP Morgan CEO Dimon warned that it was still not appropriate to beat inflation too soon, and that the Fed would raise interest rates above 5% if prices were proven sticky. At the same time, fears of a recession are also rising. At one point, the 2-year and 10-year Treasury yields are inverted by more than 80 basis points last week, the highest since 1980s. With the recent downturn in U.S. manufacturing and real estate and growing signs of cooling consumer demand, institutions worry that the Fed's hawkish stance will make a soft landing more difficult. In its report, Deutsche Bank predicted a 90% chance of a recession this year. Schwartz told reporters that the data showed that while the labor market is still resilient, there are clear signs of economic weaknesses entering 2023. With the impact of monetary policy emerging, the recession is expected to begin in the second quarter as consumers accelerate spending control and companies cut hiring and investment. He believes the U.S. economy will not suddenly stall, and the Fed will continue to assess the economy through data and wait for further signals of falling inflation after reaching the end of interest rates, leaving uncertainty at point of the policy shift. Investors' confidence was low and money continued to flee. January non-farm trading could be a watershed for U.S. stocks this year, with the past Wednesday weak growth stocks dragging on the Nasdaq and the S&P 500 recording its biggest weekly decline in nearly 2 months. In addition to Fed policy expectations, the market has also shifted its focus to corporate earnings and the economic outlook. So far, nearly 70% of the S&P 500 stocks have reported results, and all overall earnings are significantly below their historical average. Poor guidance from several companies, including online travel platform Expedia and ride-hailing platform Lyft, has raised concerns about consumer discretionary sector and the potential of economic recovery. Consumer discretionary is the best performer for the S&P 500 index so far this year, up more than 14% according to FactSet. As the earnings season began, news of layoffs and business changes in the face of economic and operating pressures. China Business News noted that institutions further cut their earnings forecast in the first quarter of this year to reflect the impact of interest rate hikes on the economy and the impact of enterprises in various industries. Regardless of the energy sector, the S&P 500 index earnings will fall by more than 5% this quarter. Capital flows up. The U.S. stocks fund recorded 12 consecutive weeks of net outflows. Refinitiv limper. Investors sold $436 million of U.S. funds in the week ended Monday. Data 2. Meanwhile, net sales of money market funds, an important hedge, reached $19.78 billion, a new high in nearly 7 weeks, also a sign of market anxiety. Institutions continue to warn of market adjustment risks. JP Morgan strategist COVID reiterated that investors should choose to sell on rallies and that anti-inflation trend could be temporary. The first 3 months of the year could mark a turning point in the market, with the U.S. stocks falling in the second and third quarters, with the Fed possibly holding interest rates high for some time. Fundamentals will deteriorate again by the end of the year. Bank of America strategist Harnett also saw the start of the year as a bear market rally, and the upcoming January CPI is important to help markets further clarify the Fed's policy stance. It sees short-term highs in U.S. stocks, and then investors will turn to recession fears and choose to swap stocks for bonds. Charles Schwab wrote in its notes that the Fed's attitude has left investors hesitant. The S&P 500 is now trading at 19 times forward earnings, given the sharp cut in its short-term earnings forecasts. In the current monetary policy and economic environment, this is clearly not reasonable. With key inflation data in the coming week, money has been playing with Fed policy, and many investors need to wait for the data to be clear before making a decision. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.